Okay, so welcome to the first Friday of the year. We are hosting the Small Business Friday updates. We've got lot of really good information, as has kind of been the consistent theme during this whole pandemic era. Things are constantly changing and constantly evolving. We have an exciting lineup. We've got a labor attorney, Tyler Woods, who's going to cover labor law updates, Hilda Kennedy, who is going to cover the stimulus package overview. Omar Morel will give us an SBA update for different lending options that came out of the stimulus package and that already existed. Myself, Nicolas Pulecio, will go over some grant opportunities and different tax implications that have changed, and then we'll open it up for questions at the end. For your questions, please write them in the chat box. We will be going in through them in sequential order at the end. Please mute yourself in order not to interrupt anybody else. We greatly appreciate that. Okay, and Tyler, if you're ready, you can kick it off.
I am. Thank you, everyone. I am getting a little audible here on the topic. Instead of California AB 5, which has been around and a lot of people have adjusted to, I think a more sort of relevant topic for today's purposes as we start the new year, and that is of most interest, maybe even people don't know it yet, is the changes to California Family Rights Act. The reason why I want to talk about it today is because prior to January 1, 2021, the California Family Rights Act did not apply unless an employer had 50 or more employees. As of January 1, the California Family Rights Act now applies to employers who have 5 or more employees. So that is just about every single employer in California now who has to comply with the California Family Rights Act. On top of that change, which it will be a big burden, will require people who didn't used to have to comply with all the requirements of the California Family Rights Act. Even those who previously did now have additional requirements. For example, under the current under the former California Family Rights Act and the FMLA, an employee is eligible if they work for an employer with 50 or more employees within 70, that has 50 or more aggregate employees within 75 miles of the main work site. And they also had to work for 12 months, and they had to put in 1,250 hours within that 12 months. The new CFRA eliminates the 50 or more employees within 75 miles requirement, meaning you could have 50 or more employees anywhere, because I have clients who have, for example, an operations in LA and a separate operations in the Bay Area, and they did not have 50 or more at any one location, so the CFRA did not apply to them. That is now no longer the case. If you have 5 or more employees anywhere within the company, the CFRA applies to you. The other big change that is applicable to everyone, even those who previously had to comply with the CFRA, is that more family members for whom an employee may take medical leave apply. As you may have been aware, under the California Family Rights Act, if an employee could take a leave of absence in order to care for a close family member. And there was, though, a list of specific family members that employee could take leave of in order to care for. They could take it for their own serious health condition, of course, and under the old CFRA, to care for a spouse, registered domestic partner, parent, or child. That list under the new CFRA has grown to also include grandparents, grandchildren, and siblings. So now an employee at an employer with 5 or more employees may take CFRA covered leave to care for not only themselves, but spouse, registered domestic partner, parent, their parent or their children, their grandparents, their grandchildren, or their siblings. Essentially, everyone within their family, they can take protected leave for. Also, the new CFRA expands the definition of children for whom an employee may take leave to care for. Under the new CFRA, an employee can take leave to take care for a domestic partner's child. That is different than before. It had to be your own biological or adopted, regardless of the child's age. And also, as in the old, it capped out age. Now there's any age. You could have a 60-year-old employee who has to take leave to take care of their 40-year-old child. Another thing under the CFRA, which is unique to California, is bonding leave. Bonding leave is where a employee may leave to quote unquote bond with their new child. Under the old CFRA, an employer consists of parents who take bonding leave, take only 12 weeks of parental leave between the two parents. That eliminates the new one, eliminates these limitations, allows each parent who works for an employer to take 12 weeks of baby bonding leave. Where this comes into play is in, for example, larger companies, or I deal with a lot of restaurants where there are two parents within the same organization that work for the company. Before, you could aggregate the 12 weeks between the two. Under the new CFRA, it's 12 weeks protected bonding leave per employee. And with all of this, there comes a leave of 12 weeks, and that's what I'm for under the CFRA. That's protected leave, just like the FMLA. Again, these are all expanded from the previous CFRA, but they apply to everyone that has 5 or more employees within California. And that went into effect on the 1st, and it is in effect now. I can see many employers stepping on this landmine because in the past, they've said, well, CFRA does not apply to me, and so I'm good, I don't have to worry about it. That is not going to be the case now for the majority of employers in California. And there are many, many requirements that an employer can step on a landmine and get into trouble. Any questions on the new CFRA?
So we're going to hold questions to the end. Thank you,
Okay.
Tyler. We're going to be covering some of these other topics in more detail in coming weeks. Now, Tyler's got another engagement, but if you have any questions, please throw them in the chat.
Yes, thank you, Nicolas. And I will work with Nicolas, anyone, to answer any questions you put in the chat box at a later date. And we will be covering many, many more topics and then the weeks to come. There's just a lot to cover with everything that's happening in California. Thank you. I apologize, I have to run.
Oh, no worries. And we'll have his contact information available at the end.
Thank you.
Thank you, Tyler. Now we're going to move on to Hilda Kennedy with AmPac. They are a CDC lender, and she's has a lot of information to cover because a lot changed on the last week of the year. So Hilda, I'll just let you take it away.
Thank you. Thank you so much. I am going to cover at a very high level what's in the stimulus package. What we know about the stimulus package is that some things are still up for interpretation, and we're waiting to get that interpretation. But I think it's really important for you as small business owners to be aware of what was passed by Congress and what we understand today. And then there are some benefits for small businesses. So we all know it was a $900 billion economic relief package. It restarts the Paycheck Protection Program, and we'll talk a little bit more about what we know about that. We did receive some federal regulations on that. It For those of you who have SBA loans, whether it's an SBA 7A loan, an SBA 504 loan, a micro loan, or even a community advantage loan, there are principal and interest payments available to you on existing SBA loans up to $9,000 per month beginning February 1st. Depending on the industry, again, we're waiting on additional details, especially those industries that are hardest hit. There's going to be some additional principal and interest payments. So here, this is talking about any existing SBA loans February 1st to April 1st for 3 months. You'll get principal and interest payments made for you up to $9,000 a month on your SBA loan. In some of the harder hit industries, accommodations, restaurants, education, there are some additional principal and interest payments that will be made. As we understand it now, those payments will go through September 30th, 2021 for those harder hit industries. We'll give you more details about that in some of our future sessions, but know those benefits are part of the new stimulus package. We also want you to know that if you're planning, if you're growing and you're going to get a new SBA loan, the stimulus package also includes the benefit of principal and interest payments up to $9,000 a month from February 1st to September 30th for SBA loans approved after February 1st. Again, we're waiting on additional details. I have to say that multiple times because, these things change. If you remember the other CARES Act, things were changing every other day. So please know that's why we're doing this series, so that we can give you the most current information. The stimulus package also waives SBA loan fees on new SBA loans, and it also includes some refinance provisions of SBA loans that we'll have more information on in the future. Next slide. For PPP loans, and Omar Morel is on, so he'll jump in as well, but the PPP allocation in this stimulus is $806 billion. The program expires March 31st, 2021. We have not been notified on the exact date that they will open up the portal for us to submit PPP loans. What we do know is that there is a special carve out for small businesses under 10 employees, for women and minority businesses, and that they will be able to apply for PPP in a special window before the full window opens up. And we'll have more details again in future sessions about that. Next slide. The general terms of the PPP loan remain the same, so I won't spend a lot of time on that. Interest rate 1%, 5-year term. The maximum amount this time is $10 million. It is 100% guaranteed. There's no collateral required. There's no personal guarantee, just like the first and second round of PPP. The new definitions of PPP, you have first draw PPP loans. These are businesses that are getting their first PPP loan. And then this term of second draw PPP loans. These are businesses that previously received a PPP loan. They've used the PPP loan. They will use the full amount of the PPP loan before the second draw is dispersed. So be aware of those two terms. If you've received a PPP loan, you're considered second draw. If you haven't, you're considered first draw. On second draw PPP loans, the general parameters, 300 or fewer employees. There is a revenue reduction requirement in getting a second draw PPP loan. If your business is grown and you have not had a revenue reduction between 2019 and 2020 of 25% or greater, you are not, based on today's IFR or federal regulations, you are not going to be able to get a second draw PPP loan. The maximum loan amount is $2 million based on 2.5 times the average monthly payroll, consistent with the previous time. And I'll tell you some exceptions there. And businesses that are part of a single corporate group, your second draw in the aggregate cannot be more than $4 million. The other critical note that I want to make is if you've gone through the PPP forgiveness round and you got an advance, an idle advance, they were reducing your PPP forgiveness by that advance. That has changed. They've eliminated that. So that advance, you will get your full PPP forgiveness even with your advance. That's a key change in the new stimulus package. Next slide. The documentation requirements are the same. In fact, if you're getting a second draw PPP, you should not have to add any additional documentation. The key is staying with the lender that you got your first draw PPP loan, assuming they're going to do PPP this round. Staying with that lender, they'll be able to easily upgrade or give you an additional allocation of the second draw of PPP loans. You shouldn't have to add any additional information. There should be looking at 2019 data and comparing it to 2020 and seeing that reduction. Next slide. For first draw PPP, this is your first PPP loan. You did not get a PPP loan in the first two rounds. A small business concern with revenue under $10 million. Yes, you can be self-employed. Yes, you can be an independent contractor. Yes, you can be a sole prop. A tax-exempt nonprofit organization is also eligible, a veterans organization, including religious organizations. Churches are still eligible under the PPP provisions. You must have 500 or fewer employees, including affiliates. It can be a housing cooperative, a news organization, and ESOPs are also eligible. And the business, like before, has to have been in operation by February 15, 2020. The eligible uses are fairly the same, but there have been some additions. So payroll costs, anything related to group health care insurance that you contribute, mortgage insurance, mortgage interest payments, rent payments, utility payments, all of those are consistent. Let's go to the next slide. These are the newbies with the uses of PPP funds. Refinancing an SBA idle loan made between January 31st, 2020 and April 3rd, probably not as relevant for California, more relevant for other parts of the country that may have had an economic injury disaster loan. But what's really significant is covering those costs related to the pandemic. You have to have your employees now working from home. So any cloud computing services that the businesses had to purchase, or tracking of payroll expenses, sales or billing functions, any of those kinds of expenses are eligible under PPP. If your business was damaged, your property was damaged, your commercial property was damaged as a result of looting or some of the public disturbances, that can be covered above what the insurance company provides. And then any supplier costs for operations that are essential to the business, that can also be included in eligible expenses in that 40% of the PPP loans. It's still the 60-40 split, 60% payroll, 40% other costs, and these are some of the other costs. Next slide. Also, worker protection expenditures, that PPE equipment that you may have to do because your business has been in, because you need to keep your employees safe, whether that's adding a drive-through window, indoor or outdoor ventilation systems that you have to add to your business. All of those things are covered in those other costs with the new requirements. And then even particulate filtering face piece respirators or other kinds of protective equipment. Those things are covered under the new PPP guidelines. Next slide. The covered payroll costs, again, all of those are virtually the same as they were in the first round, so I won't go through that in detail. Next slide. And the way PPP loan amounts are calculated are the same. They're going to look at your aggregate payroll costs in 2019, not 2020, because of all of the issues of 2020. And then they're going to take the average of those payroll costs, of course, less any employee that makes over $100,000. They're going to multiply that by the monthly average 2.5 times, and then add any amount if there is an idle loan that needs to be refinanced within those dates that I mentioned. That's going to be your total PPP loan amount. Again, any advance under the idle COVID-19 loan does not have to be repaid, which is different from what it was in the first round of PPP. Next slide. Let me talk about the exception. So if you're in that NAICS code, that 72 accommodations or services sector, your maximum loan amount is equal to 3.5 times your average monthly payroll cost that don't exceed that maximum. So that's an important point. So before, or if you're not in one of those affected classes, it's 2.5 times. If you're in one of those affected services, it's 3.5 times your average monthly payroll cost. I'll turn it over to Omar.
Thank you so much, Hilda. This was amazing. Omar, I'll let you run with it.
All right. Well, good morning, everyone. And thank you to Hilda for covering all of that. I'll clarify one thing that Hilda mentioned. She mentioned about not knowing exactly when we'll open for applications. The SBA had a press release about an hour ago. Things are changing, right? Which as they always do. So community financial institutions, which will be smaller CDFIs like AmPac that Hilda is part of, and community banks, meaning that if you work with a PPP lender that was on the smaller scale of things, a community bank or a CDFI, first draw PPP loans will be available on Monday, January 11th, and second draw PPP loans open up on Wednesday, January 13th. And then it only says that it will open up for everyone else, for the larger banks, you know, the Chases, the Wells Fargos. I'm not sure where they're going to draw that line, but certainly the larger banks it will be available to those of you who work with them shortly after. So we still don't have that date. So small update there for you all. So let me get into again, some of the specifics of what the new stimulus package provided. And again, Hilda already covered some of this, but you know, just to reiterate it because it is so important. For those of you who do have an existing SBA loan of any kind, similar to last year, where 6 months of principal and interest payments were made for you or were made on your behalf by the SBA, that will be reintroduced for 3 months this year. The difference, however, is that there will be a $9,000 cap. Rough numbers, for those of you who have a 10-year 7A loan, you will be looking at that you'll have full coverage of your payment if your loan was somewhere in the $800,000 to $840,000 range. And for those of you who have 25-year either debentures, so that's a second loan on your 504, or if you have a larger 7A, it'll be in roughly the million, somewhere in the million or 2 million range, again, just depending on interest rates and a lot of other factors there. So that's again going to be phenomenal. The important piece is for every dollar above $9,000, you will still be expected to make that payment. So ensure that if you have an existing loan that you are working with your lender, if your payment is above $9,000, you're still going to have to go ahead and make that full payment. And in the event that, let's say that there's an additional principal or interest paid because of this double payment, your lender will work with you and ask you how you want them to handle it, whether it's a reduction in principal or returning that payment made to you. So for those of you who have quote unquote smaller loans, you're in great shape. For those of you who have larger loans, make sure you're working with your lenders. Hilda also mentioned that there will be an extension for certain borrowers. Payments made through September 30th. So it's essentially 8 months of payments. I think I did the math right there. So again, if you have a SBA microloan or a community advantage loan, which is a smaller 7A, and you probably know if you do, you'll have those payments made through September. And then again, hardest hit industries. We're still waiting for this to be defined. This is going to be very important what this means. But Hilda mentioned the top ones that we're expecting to be included in there: service-based industries, food and drink, and education, and so on. I think another really important piece of this is that for those of you who have existing SBA 504 loans, there's provisions allowing for you to be able to refinance your first trust deed with your existing bank and expand out and take out a little bit of extra cash to cover eligible expenses. Again, waiting on the details of that. That's going to be a really important piece, but it will allow you, those of you who have an existing 504 loans, to simply do a modification on your first trust deed, get a little bit more money out from your current bank, and the CDC will work with them to resubordinate. So these are things that are normally difficult to do that are being made easier to do as a result of this package. And again, details to come on that. Now, I think this is that's everything I just covered. That's for existing borrowers. This is now for folks who are considering new SBA loans. Maybe you don't qualify for round 2 of PPP because you didn't have that 25% drop. Maybe the pandemic actually has caused growth in your business. Certain fields are certainly seeing growth, and you need to hire folks, or you need to expand your business, or you need to purchase a building. This is going to be the rules for these new SBA loans, and it's in effect through September 30th and begins February 1st. So any new 504 or 7A loans will get those payments made through September 30th of 2020. So it's very important. Hilda already mentioned this, but the guarantee fees, so that big cost that's associated with these loans, that guarantee fee is being waived. Specifically for the 7A loan, on the bank side, we're going to actually get a higher percentage guarantee. So we may stretch a little bit more. You may see the banking industry stretch a little bit more on a credit because we are being incentivized to do it. So this new stimulus package, in our opinion, my department, we thought this is what they should have done last year. And I think they're doing the right thing this year. Because this is what you want to see. You want to make it easier for borrowers to borrow, and you want to make it easier for banks to lend. And that's the effect of these two pieces. The next bullet point, this is something we're really excited about. For those of you with real estate loans that were financed with an adjustable rate 7A loan. We're waiting for details. We really don't know how the SBA will interpret this and how limited they will make this or how open they will make this. But for those of you who have adjustable rate 7A loans, Sometimes they can be difficult to refinance conventionally because you borrowed it at a high loan to value against your building, and it may not have lowered enough to meet conventional requirements. The new Stimulus Act allows for that for a SBA 504 loan. So that's that one with a really long fixed interest rate to be used to refinance these. So again, it may only be certain industries. It may be certain types of loans. There may be date restrictions. There may be all these types of restrictions. And so I just want to highlight this for you, that if you have an adjustable rate 7A loan, pay attention and make sure you come back next week, because hopefully next week we'll have the details for you. And then the final point there, if you're looking for a smaller loan, I think Hilda, correct me if I'm wrong, but micro loans go up to 150,000. I believe that's the max.
No, the SBA microloan actually goes up to 50,000.
Oh, 50,000. I apologize. I'm thinking about something else. Yes. So
Community
for
lending.
50,000, so those loans below 50,000, some banks provide these. A lot of CDFIs like AmPac provide these. There are some non-bank lenders that provide these. Typically, those loans have a term of 6 years. That's going to be extended out an additional 2 years to 8 years. So it's going to lower the payment requirement on that. So if you fall into that category, certainly reach out to folks like Hilda, or I'm happy to refer you out to some folks that provide this type of lending as well.
Perfect. Thank you,
Hopefully more to
Omar.
come.
Yeah. Now, I did want to circle back to something that Hilda was referring to, which was the 3.5 times for. Oh, here it is. This is critical for restaurants, and some of the people who are on the call own restaurants, and so this is going to be a huge boost that didn't exist before. So make sure that this is something you're taking into account when you're calculating your second round PPP, if that is what you're going for. And then we're going to jump onto my stuff. So real quick, there are grants available. Obviously, a lot of businesses are still hurting. There are still, it seems like every week or every other week, there's new city grants or community or business grants. Stay online. There's a couple different sites that are out there that list them around, and some of them seem to be very specific by city or county or industry. The big one that's available right now is the California COVID-19 Relief Grant. This was made available starting December 30th of last year. It was most of the sites were crashing because of the overwhelming activity on those sites. It is available until January 13th, 2021. And that's open for first round of applications. It is not a first come, first serve. So get your application in. It's a generally pretty simple application. There's a certification. You have to submit some information confirming that you have a business, that you're open, that you were open. It's available for for-profit businesses and nonprofits. You have to submit articles of incorporation, driver's license, identifying information, things like that. Best way to get the only way to apply is to go to the website, californiareliefgrant.com. The grants are broken up in 3 categories: 5,000, 15,000, and 25,000, and it's based on your gross revenue. And so depending on which category you fall in, that's the grant amount that you would qualify for. They are not guaranteed. They're going to select the entities that are most in need, and you do have to certify that you have been impacted, that your business has been impacted by COVID and by the pandemic, to demonstrate a need. We are assisting our clients with these applications, but they are really straightforward. So this is something that you could do yourself. Moving on, EIDL was extended. So EIDL was reopened. It was extended for December 31st or till December 31st, 2021. If you've not received an initial EIDL, you can continue. You can apply now and receive your funding on EIDL. The applications for that are at sba.gov, and that is an application that's directly with the SBA. Now, as far as circling back to some of the things that Hilda was covering, PPP forgiveness was a big headache at the end of the year because the expenses were not deductible, which effectively made the PPP forgiveness taxable, even though you were not the income or the funds themselves were not taxable. With the recent stimulus, this has corrected that issue, which was the intent of Congress initially under the CARES Act. So the recent stimulus now has made PPP related expenses deductible for federal purposes. Here in California, we have a slight complication. Back in August, California had issued Assembly Bill 1577, effectively making California tax code fall in line with federal tax code at that point in time, which meant that PPP related expenses were not deductible. For California purposes, this is still the case. There is some hope that California might issue another assembly bill before tax season begins and rectify this issue. But as it stands right now, you can deduct the PPP related expenses for federal purposes, but they will be backed out for California purposes. So this will create a little bit of an additional twist or headache for many small businesses for California purposes.
Hey, Nicolas,
Yes.
can I just mention one thing on that with the PPP? And I didn't mention it. For those who are doing a second draw, the PPP forgiveness that you got, I've heard a lot of people wrestling with how am I going to show that forgiveness? And SBA in the new IFR clearly said that you don't have to show that as 2021 income. I'm not sure if you guys have seen those cases where people would think that they have to show that in their income. SBA is saying don't show your forgiveness in your income in comparing the 2019 and 2020 so that doesn't negatively impact you showing your 25% reduction. That makes sense?
That's a great point. Thank you, Hilda, for clarifying that. Yes, absolutely. For purposes of the California grant or the second round PPP or really any other program where you have to show a reduction in income, that's a great point to not include the PPP funds as 2020 income. Thank you for clarifying that, Hilda. Okay, and then moving on to tax credits. There was a lot of stuff covered in the stimulus package regarding the tax credits. Most of it were just extensions of tax credits that already existed. So I'm not going to cover those in detail because there's a long list. I'm going to focus on these kind of bigger ones that are specific to kind of COVID related items. So there are tax credits for businesses for paid leave, paid family leave. Now, previously this was a company had to mandatorily give or pay for leave under certain COVID related instances, right? And there was a whole list of criteria to qualify that an employee would qualify for that and what percentage of pay they would receive. The mandatory component ended December 31st. for any company that voluntarily continues to pay sick leave or family leave for COVID-related reasons through March 31st, 2021, they can still claim an additional credit for that leave paid through March 31st, 2021. Now, again, I want to re-emphasize that this is a voluntary matter on the employer side. For the employee retention tax credit, so this is for any company that retained employees or added more employees to their roster. So this tax credit was extended for wages paid through June 30th, 2021. It was previously supposed to end in December. Now we've got an additional 6 months if this is a credit that you want to take advantage of. The credit rate was increased from 50% to 70% of qualified wages. So it's a much more lucrative credit, which could create an incentive for more companies to take advantage of it. The cap was also changed. Previously, it was a $10,000 aggregate cap. Now it's a $10,000 per quarter cap per employee, which again makes it more lucrative because it changes the entire equation on this. Additionally, in order to qualify, the revenue decline criteria was lowered from 50% to 20%. So now the pandemic damage, so to speak, or economic damage doesn't have to be as egregious in order to be able to qualify for this credit. And the availability was also widened from employers with 100 employees to companies with up to 500 employees. So now more companies will be able to take advantage of this credit. One thing to note regarding this is against the employer portion of Social Security taxes. So it offsets the amount that you have to pay to the IRS when you file your quarterly payroll tax returns. To the extent that the calculation of this credit exceeds that amount, the excess is refundable. So this is something that you want to work with your CPA or your payroll provider to figure out if this is a right option for you and if you qualify and what those dollars may look like. The other credit, which was something that was a bit of a headache last year as well, was the deferred employee Social Security taxes. And for some of you who may not remember, towards the end of the year last year, there was this employee Social Security tax deferral option, where the employees could decide if they wanted to defer their Social Security taxes for the balance of 2020, but they would have to repay it all back by April 30th of 2021. So effectively, the employees were putting themselves in debt. The repayment period has now changed from April 30th to December 31st. So it continues to be debt. The employee still has to repay it. They just now have an additional 8 months to do it. They have until the end of this year to do it. Of course, like everything else we've discussed here, this is what exists as of today. This could all change tomorrow or next week. As we've seen in the past, these things evolve. But as of today, if any of your employees have taken the Social Security deferral option, the Social Security tax deferral option, the repayment can be stretched out over the 12 months of 2021 instead of 4 months, which would alleviate that burden on the employee for 2021 to effectively have to receive less compensation because of this gets deducted directly from their pay during their payroll. So that's all I have for right now. We're going to move into Q&A. We've got a couple questions in the chat box, but really quick, I just wanted to review some of our panelists. Adam Miller, who is a business law attorney with MMG. He's here to answer any business law, and he's going to take over for any Tyler related questions as well. Myself, Nicolas with Brysani, Omar Morel with American Business Bank, Tyler Woods with FisherPhillips Employment Law. Wendy Gray wasn't able to make it with us, but she's with PacWest, Pacific Western Bank, and Hilda Kennedy, of course, who so skillfully dissected all of the stimulus package stuff for us, and she's with AmPac. So we'll move into the questions, and let's see here.
So if you want, Nicolas, I'll jump in on the first question. I believe it is
Perfect.
from Andrew regarding how long is the employee allowed to care for a family member before the employer can let that individual go? 6 months, a year, 2 years? Really, the question is there's not one clear answer. The obvious is they're given 12 weeks of leave during which they are protected. You then could hypothetically have a period after those 12 years that's a reasonable accommodation period, which would apply more generally to a female because it would be disability related, whether the pregnancy created severe problems, emotional issues, which could also affect the father at the same time. But if there are other disability issues that people are facing, that period could be extended as a result thereof. So the key thing is, if you want to lay off somebody who is after their 12 weeks, I wouldn't do it automatically. You would still want to consult an employment attorney to confirm that there are no other issues and that everything is still fine in that direction, because there is sort of that gray zone of, are they in a reasonable accommodation period or are they not? That's generally the issue with California law frequently. So far as the employment stuff, though, I won't be able to answer all of them if people have them, but feel free to ask. I'll do my best where I can. You know, one thing I've learned during COVID is the laws are changing so quickly, whereas a business attorney, I used to have a greater understanding. There's so many new nuanced things that I much more frequently than ever before bring in an expert like Tyler to help clients out, just because of how quickly the laws have been changing.
Absolutely. Thank you, Adam. So we just had another question. Are the EIDL grants still available? Yes. So the EIDL grants had closed down for a period. They've now been extended, as we mentioned. So if you go to sba.gov and follow the links for the EIDL application, you can apply now. Those are available now for first-time EIDL grants, or first-time EIDL loans, rather. Doesn't look like we have any other questions. So again, you know, some quick housekeeping matters. Oh, we just got one popped in. Does the CARES Act apply to companies with less than 50 employees with regard to paying up to 80 hours of sick with COVID? So that is the family relief portion that we mentioned. So that part actually ended December 31st. And so, as I mentioned, that, if I'm not mistaken, is voluntary, and you qualify for the credit, for the tax credit related to that through March 31st. But the mandatory component of it ended December 31st.
Nicolas, just to confirm, the voluntary part, it's still, if somebody got it before in 2020, it does not renew for 2021, correct? It's only a one-time for each person, no matter what, the cap, correct?
I believe so, yeah. So if it's a new sick leave in 2021, then it's voluntary. Voluntary from the employer's perspective.
Yeah, no, Nicolas, what I'm saying is, and this thing that I read the other day, and I believe it confirms the case, because I think it's important, if a parent had a kid who had COVID back in May and they used the max 2 weeks permitted back then for the employer, the extension through March doesn't increase the amount of time available. It is only a continuation of before. So if they took it back in May, the full 2 weeks, they don't get a new 2 weeks in 2021. It's already been used, correct?
Correct. Okay, we've got another question here. What will be the best loan to apply for if your own income property in Riverside County where some tenants are not paying rent and owner has extensive repairs in 2020? Omar, that might be you.
I'm not sure if the grants apply here or any of the state, but unfortunately, income property or that type of business is considered passive in the SBA world, and it's not eligible for the SBA loans. So I'm not sure if there's any other county specific or state programs that are available.
We are we're administering a loan program in Riverside County, but that, like Omar said, it is not for passive income businesses, so it would not apply. We're also a partner with the California Relief Grant, and that passive income kind of business is also not eligible. I'm not sure about where you go, but I did hear on one webinar that there is something through the state and their community development block grant program that could be available. I don't know all of the details, but none of the loan programs that we're managing or grants for small businesses cover passive income.
Yeah, and the California COVID relief grant unfortunately doesn't cover passive income either. So when we send out the additional information after this, we'll put in a link to that community development as well. Then we've got another question here. Looks like it's regarding the paid sick leave. So what if the employee used their sick paid time they had available and then used their vacation? So I think, and Adam, correct me if I'm wrong, but I think that would fall still under the previous assumption that that was all used. Anything new for 2021 would be strictly voluntary under the employer's discretion.
Yeah, no, so it's an issue of the tax credit. So the tax credit did not renew for brand new one in 2021. So if you got the full tax credit for the person in 2020, it is not a restart in 2021 where there's more time. As the employer, you could obviously permit them to take more time, and they could use whatever sick leave they may have for 2021. But if you give them more time than that, I do not believe you'll be able to apply for a new tax credit for that person in 2021.
Perfect. Okay, very good. Okay, looks like those are all the questions. So we did record this session and we will circulate the slides. We're only going to make the recording available for a week because effectively everything is changing. We'll be back next Friday with new updates and additional information based on whatever's changed between this week and next. We are anticipating to do this weekly until things settle down, and then we'll switch to a monthly format. It will be the same link. I encourage you to register ahead of time. I will send the link available out for the recording, and we have your information if you registered, and that way you can circle back and watch it at your leisure. But again, as I mentioned, the link will only be active for 1 week. Unless there's any more questions, I don't see anything else. Thank you so much, everyone. I appreciate your time. Thank you to the panelists. Incredibly great information. Thank you so much. And have a great Friday.